Welcome everyone to another Wednesday webinar. Chris and Stephen are traveling today, so we are stepping in to fill in their place for you guys. I've got Chris Brown here, who's the president of Tax Hive, and Jake Alexander here, who runs the accounting division for their whole company. And today we are going to talk about taxes, beginning, intermediate, advanced, anything you got here. We will start a general discussion about everything and be able to get the lovely topic of taxes, hopefully understandable for all of us. So. Welcome, gentlemen. I don't know if you want to say a little something about yourselves and maybe where to begin.
Go ahead, Jake. I'll let you jump in to begin with.
Well, I just want to say, when I hear taxes, I get really excited. I don't know about you guys. Most people on here, or just in general, they're kind of the opposite. But to me, it's, this is like somewhat of a second career for me. And what was so exciting is just like the more I learned about it, the more benefits there was to it. And, and it applies to a lot of the things that you guys generally teach in your shows and in your programs. And so I'm really excited to be here. And I'll pass it over to you, Chris.
Yeah, we're just excited to be here. We're partners with Kevin O'Leary, as most of you know already. He's one of my partners in the business, and his DNA runs through our business. We're big believers in what you guys are doing. I mean, entrepreneurship, investors, is the lifeblood of this country. The majority of jobs in this country are created by people like you, and we're just a big believer in what you all do. And we know part of creating wealth is keeping more of what you make and keeping as many of those hard-earned dollars in your pocket as you can. And the tax code's written and designed to incentivize investors. Regardless of what side of the aisle you're on, the tax code is written and designed to drive investing in this country because of the amount of jobs and economic activity that comes through small and medium-sized business owners. And with Kevin's DNA, our goal is just to help our clients keep as many of those dollars in their pockets. Why? Certainly so you can take a vacation to Hawaii, but more importantly, so you can take those dollars and reinvest them and grow and do additional things, and not avoid taxes, but only pay what the law legally requires you to pay. So, we're excited to be on here and to have a conversation. And I'm hoping, while we do have questions, I'm hoping that we can really drive the bulk of this conversation from you as a group and have you throw in the questions into the Q&A box. One thing though that I'd be curious to, if it was all right with you, Shauna, just to start with, I'd love to say, hey, let's keep questions in the Q&A box, but in the chat box, I would love if we can just kind of get a lay of the land. I know that there's a lot of different kinds of investors on here. I would love to just kind of get a feel for who we have on here today, if that's okay. Tell us a little bit about what you're doing. Are you private lending money? Are you flipping properties? Are you doing commercial? Are you doing rentals? If you wouldn't mind, I'd love just to kind of get a lay of the land to start with and just have everybody throw into the chat box what they're doing so we can kind of have an idea of maybe a starting point, if that's okay, Shauna.
Yeah, absolutely. Looks like a little bit of crypto trading, some private lending, single member LLC, rentals and lending, land flipping, life insurance broker.
Rentals, crypto, Airbnb, rentals, tax liens. So we got a great swath, I think, across the board. So I think we can answer.
Franchisee. Yeah,
franchisee, stock trader, and a partner in a small business, wholesaling loan broker. That's great. We're big believers that everybody in this country should have a business. And the reason is the tax code opens up to you and just allows you to really take advantage of the tax code. So maybe a place to start, if it's okay, Shauna, I think it might be good for everybody just to understand a little bit of the lay of the land right now with taxes. Mm-hmm. If I can just start kind of peppering Jake with questions, and certainly you jump in. Does that sound like a fair format for you, Shauna?
Yeah, absolutely. I think most of everybody probably starts somewhere with a W-2 job at some point starts saving and then realizes that they want to start investing in their own self, or have some sort of, if it's a rental portfolio, or lending that money that they make. So I think that speaking from that transition, because sometimes too, there's that comfortable, like, even myself included, I'm a W-2 employee for Chris, and there is some sort of level of comfort there because I've known W-2 since I was 16 years old. So I think it's really like interesting to encourage people to make that transition into all these other investments. So I'd love to, I guess we can take it away from here too.
Well, listen, that story right there, Shauna, that's my story, right? In fact, I remember our first business. Many of you might laugh at this, and I about had a come apart. I walked into our family room. I was a W-2 employee. My wife was a stay-at-home mom, which was the hardest job in the world. And her and her friend, I walked in, there was $8,000 worth of t-shirts sitting in my family room one day. And they had got this harebrained idea to sell these shirts at the state fair. And I thought, what in the world's going on? And I'm not recommending that that's the right way to approach things, but I remember that was my first venture into actually recognizing all these ancillary benefits that came. And since then, obviously, we run a number of businesses. But man, I remember that thinking, what in the world did you just do? You put $8,000 on our credit card on shirts. And to their credit, they sold them, they made money, and actually ended up making a lot of money. But I think we've all been there, right? We've all kind of been through that transition. Jake, I'd love just for you to kind of start with, tax codes change, things are different now than they used to be. I know you've got some challenges going on at the IRS yourself, just with kind of, but maybe just give us a lay of the land for taxes as we were in the full swing of tax season. And then let's try to get into some specific questions from the group and give some real good, solid, sound advice.
Yeah, absolutely. And I think that's great. I can give kind of just a general overview of kind of how we got to where we are right now. And then Shauna, kind of like to your point, I'd love to hit on that too a little bit. And just to kind of give people a timeline, because, right now, I know everyone knows it's almost impossible to get a hold of the IRS. And so what I love to do is rewind just a few years, so the IRS has never necessarily been known for their timely responses or great customer service ever. But so in 2018, we passed this thing called the Tax Cuts and Jobs Act, which was the biggest revision to the tax code in like almost 30 years. I think it was like 27 years or something like that. Like literally the biggest change to the IRS tax code in almost 3 decades. And so they did that. And then, obviously a few years later, we had the shutdowns with COVID and all that kind of stuff, all the crazy stuff happened in 2020 and 2021. And the IRS was literally not set up to have employees work from home. So when the shutdowns happened, the entire IRS, they shut down. They had computer technology from the 70s still, and they weren't able to do it. And they're still not caught up. I was just reading articles the other day, and there was something like 25 million tax returns from 2020 from last year that they're still on backlog to be processed. And so just to kind of give everyone a lay of the land is, the IRS has never necessarily been known for quick turnarounds and things like that, but just the past, 4 or 5 years have really put them in a situation where it's almost impossible to get a hold of somebody there, even for us who have like the secret hotline that you're not supposed to give to anybody else that's supposed to get you right in. That one doesn't even work anymore. A lot of people are getting, penalty letters and asking for the penalties to be waived and not getting responses. People for their S elections, you're supposed to get correspondence to that. They're kind of just not coming. And so, I say all that to say, if having your stuff together and in order now is more important than ever, because, the IRS just really isn't in a situation to tell you when it's wrong. And so when you need these financials for getting approved for loans and you need to have your returns done and stuff like that, I think for us, it's been a very interesting past few years, not to mention the child tax credits that came out and all the stimulus payments and all these kind of things. Like for people who've been in this industry for years, the last 2 or 3 years, it was a completely different tax return that we're looking at. There's sections on there for cryptocurrency now. So, I know everyone thinks that just as of late, there's a lot of activity around crypto and a lot of people are doing very well, but stuff's been around for 10 years. The IRS has a box on the first page of the tax return, like right underneath your name, your address, your social security number. You have to click a box that says, did you I don't know exactly what it says, but basically, did you participate in crypto? And you have to report that to the IRS. So I think now it's just we're in a time where, you know, they're backlog, they're hiring people like crazy. They're actively trying to hire like 10,000 reps to just fill positions that are available there. But it's on us kind of, you know, on our side to make sure everything's accurate and you're reporting it, because you don't want to have any kind of issues later. So, you know, that's a little bit of a overview of kind of where the IRS stands at the moment. And then, you know, Shauna, kind of like you said, you know, you're a W-2 employee. People like you, like, what can you be doing to help with taxes, and, you know, what kind of strategies can you employ and stuff like that. I love having those conversations. And the best thing we tell people is you become a business owner. If you're a W-2 employee, that's great. You know, you're earning income. Every week when you're getting your paycheck, the employer's automatically sending taxes to the IRS on your behalf. So you're okay. You're not going to get caught off guard. The absolute best thing you could do is, in my opinion, would be to start a side business. So something where you're a contractor somewhere, you're getting a 1099, and that opens you up to all of the deductions that business owners are privy to. And in the beginning, it might not be much, but over time, this stuff adds up. And what it'll start to do, kind of like, you know, the message Chris said, is it's really just becomes eye-opening of like, wow, this is, you know, now I'm earning W-2 income over here that's having taxes withheld, but I'm reporting a loss on my 1099. So that actually lowers the amount I have to pay. So I get a bigger refund at the end of the year. Like, that's really cool, you know? And then from what we see is that leads to the next thing. All right, well, now how do I invest that money? You know, how do I turn that earned income into passive income? Because now we're really talking, like, I don't have to do the work to get the money. Like, now we're really, you know, moving in a good direction. And so I love having those conversations, really just giving people those light bulb moments of, if you're a W-2 employee and that's your sole source of income, the best thing you could do immediately would be to start a side business. So
I might add one thing just this time of year for everybody to be aware of. You know, in our world, you know, everybody kind of thinks of these tax deadlines, March 15th and April 15th. And, you know, really, this might sound funny to you, but it doesn't actually feel like tax time to me right now, personally. In the business, it does, right? But you know, personally, I filed an extension and my taxes aren't due till this fall. And I think as a business owner, that's often a great thing to do, is to get an extension in and buy you time. It just kind of slows the process down. You're not having to rush through things this time of year like people typically do. But the one reminder that I think I would give regarding that is that buys you time to file. It doesn't buy you time to pay. And so the IRS, if you file an extension and you wait till September or October to file, they're going to expect you to have paid. So a good rule of thumb is to pay what you paid last year in taxes, and then reconcile that when you actually file your return. So filing an extension is a great thing to be doing this time of year. It takes some of that pressure off. It buys time. It does all sorts of great things. But make sure you've made payments and you've paid what you paid last year into your taxes, because that isn't going to go away. The IRS doesn't extend that deadline. They expect you to have paid what you paid last year. Or if it's less and you know it's less, you can pay less. But kind of a good rule of thumb is to pay what you paid last year, so you don't begin incurring penalties and other things of that nature. But extension's a great thing, but make sure you've paid. I see we've got a question from Colleen. Can we jump in and answer that? Is that all right with everybody?
Yeah, absolutely.
So she asked Jake, it looks like she's a private money lender, and she's worried about how to navigate interest income. You know, so I'm lending money, I'm private lending. Well, just talk us through the things that we need to be aware of when we're managing interest income.
So this is, you know, I briefly mentioned it a second ago, but interest income falls under passive income, which is amazing, right? It means we're earning money, you know, our money's earning money for us. The IRS is smart though. They're not going to let you offset your passive income with earned income. You can, however, offset it with strategies. You can offset it with other passive income losses, and some strategies we see for that are rental properties. You know, when you get a rental property, you automatically qualify for depreciation. And 9 times out of 10, well, it depends on the situation, but a lot of times, you know, people with residential rental properties can be positively cash flowing. So they're bringing in the rent every month. You know, they're strategically taking a loss on their tax return because of all the deductions and the depreciation. in the assets going up in value over time, but that loss that the depreciation will help you create could be a really good way to offset some of that passive income. And then if you do kind of more of like an advanced strategy, if you get into investing in commercial real estate, there's cost segregation studies that can help offset the passive income too. So there are a couple strategies out there, but that's one of the hardest to write off, because it's also one of the hardest to get. So
if I'm not, if I'm taking passive income, let's say is in Colleen's case through interest, but I don't have rentals, I don't have that set up yet, how am I going to be taxed on that? And what do I need to be prepared for?
Yeah, so you should get a 1099 INT from whoever the institution is that's paying you the interest. And so that gets reported on your tax return as ordinary income. So
this is a real broad question, so it's going to give you a swing at maybe a real broad area, Jake, and I might chime in here too. But this individual just started a corporation this year. It's their first time as a business owner. What maybe advice might you give when it's our first time? You know, we've been a W-2 employee our whole life, and now all of a sudden, you know, we've got some losses, we've got some expenses. What advice might you give to the person sitting in that boat?
Yeah, and I love those. Those are some of our favorite clients to work with, is like that first time business owner. There's like always a level of excitement there, but the best thing you do is track your expenses, track your income, and make if you're bringing in income, you want to be making estimated payments so you're not caught off guard at the end of the year. I think that a lot of times we see this happen where people switch from, you know, W-2 income to 1099. They don't realize, oh wow, my employer used to withhold those taxes and send them to the IRS on a regular basis. Now it's not happening. So, you know, people get into real estate, we see this happen a lot, all kinds of different industries. But the biggest thing would be, don't get caught off guard on the taxes. If you're making significant income, expect to pay something on there. So have a conversation with a professional about that. And then just track all of your income and all of your expenses. Set up a separate account other than your personal bank account. So it's not like when you were W-2, like Shauna, I'll pick on you a little bit since you offered the information earlier, but
yeah,
you know, Shauna, more than likely, she gets her W-2 paycheck deposited into her personal bank account, and then she goes to Starbucks and pays her rent or does whatever she wants to do because it's her money. That's the worst thing you can do when you go to 1099. You want to set up a separate account where all of those deposits are going to go into. Then you want to run business expenses out of the business account and then transfer money over to your personal account to do your Starbucks and your rent and all that kind of stuff.
I have a question sort of based off what you said and kind of going back to Colleen's question a little bit. So say your side business is lending, because we do have a few people in our audience who are you know, doctors or surgeons, and they make a lot of money at their job, and so they'll take hundreds of thousands of dollars and lend it out. Is there a way to make, like, and this is just a question, I have no idea if this is like makes any sense, but when you get that interest money back, is there a way for it to not be income but be more of that lending, like more of your, like, building your business in a way where it's not just your income but it's money you're going to lend again? So is there a way to kind of like, because you're not taking all of it and putting it in your pocket, you're going to lend it more? I don't know if that makes sense.
No, I love it. I love the creativity questions. And so the short answer is no, unfortunately. The IRS is really smart with this stuff. So even people who are set up as corporations or as S corporations, they actually report. I was just working with a client on this yesterday. They report their business income on one line, and then all the interest income that they earn, it gets reported on a separate line. So you could separate it out, but the way the IRS sees it is as passive income. So it's just taxed a little bit differently. So, and it's interesting. It's one of the hardest ones to get, but it's one of the hardest ones to deduct against too. So.
Okay. And then also, how do you start? So say it is like a doctor or a surgeon who has like $200,000 that they've already been taxed on from their job. What does that look like when you start a business with that money and you like let the tax man know, like, I've already paid tax on this money, so this is like a untouchable, like, how do you do that?
Great question. So kind of back to, if it's your first business or 10th business or however many, The tracking is important. So when you originally put that money in, we're going to track it in the books as a loan from shareholder or contribution from one of the partners. And so it's tracked in the books separately to where you're not going to pay taxes on that money when you take it back out. So,
Okay, cool.
And I think the key thing there, right, Jake, that we talked about is, and it comes back to what you said a minute ago, which is good records. And I know that sounds really boring, right? But I can't tell you how many times we see a client come in and they say, man, things are messed up a lot for the last 5 years. And can you help me out? And as great as our team is and our staff is, we're only as good as the information we have. And if we don't have, I like to call it defensible data, right? We have to be able to defend whatever stance we take. So keeping books, these separate bank accounts, things like that actually matter and make it a lot easier and a lot less expensive to do it the right way than if you've created a rat's nest that you need to somehow unpack. It's a really good question. I'm seeing a couple of questions come into the chat box, which is great. But just a reminder, if you throw those in the Q&A, the chat box kind of gets filled up with people. So if you throw your questions into the Q&A, that'll just help us, I think get through the questions. I think this is another one, Jake, that, and I know this varies, but just some rough ideas. I'm seeing we have a lot of people investing into crypto. Kind of in the back of their head, what should they be setting apart from their earnings for taxes, right? Is there kind of a rough number that you would say, hey, start with this so you're not surprised? Where should they start?
Yeah, starting point would be 20%. A lot of times crypto transactions, for whatever reason, are short-term instead of long-term. There's a lot more kind of activity than, like typical stocks, or at least the stuff that we see. So if you, and try to not get too in the weeds here, this is where I can really nerd out. So if I do, just stop me and cut me off. But if you're holding it for less than 12 months and you're selling it and you're making a gain, that gain gets taxed at whatever your regular income, your ordinary income tax rate is. So if you're a high income earner, your regular rate is 30%. This crypto that you're buying and selling within 12 months, the profit is taxed at that same percentage as your ordinary income. If you hold it over 12 months, it can go down to closer to 10 or 15%, just depending on the situation, depending on your overall level of income. So a good rule of thumb is if it's short term, at least 20%. If it's long term, more like 10 to 15. So,
and I think, Jake said it, but I'm just going to reiterate it because we see this all the time. And this doesn't just apply to crypto; it applies to a lot of things. Typically, assets held over a year get taxed differently, right? They move to this long-term capital gains rate that, especially if you're a high income earner, it changes your bracket significantly on those dollars. And again, I can't tell you how often we've seen clients at 11 months liquidate an asset, and Jake's mind wants to explode. He's like, if you would have just waited 14 more days, you would have paid half the amount in taxes. So, I think a great piece of advice is when you're liquidating assets, have a quick conversation. Send an email out to your tax professional, whoever it is, and just flush out, is this okay, or should I be doing something different? Now, Jake, I saw, and this is down the list a little bit, but I think this is a really important question to answer that I saw come in is, well, what if I bought crypto and I'm just holding crypto and I haven't liquidated any of it yet, I haven't recognized any profit on it. Am I obligated to report that, or am I just waiting until I recognize it? How does that happen in the process?
So, and that's an awesome question. There's no responsibility to recognize the gain because there isn't a gain yet. But that little box I said that's on the first page of the tax return, way up at the top, like really important information, you have to put if you're holding crypto. I can't remember exactly how it said, but it's holding, trading, or recognizing gain from crypto. You do have to click that box and recognize that part. So
I think, one thing for those of you that have done this before, crypto has kind of shifted from this Wild West, and it still is a little Wild West, to it's being treated now a lot like stock trading is treated. In fact, the rules
very
are
similar,
almost identical, right? I think it would be safe to say, Jake. But I am going to throw a caveat on here while we're on crypto. And Jake, you and I did an entire training to our clients on this just a couple of weeks ago. But there's this whole other avenue of crypto where we mine crypto. You know, we've heard of mining crypto. We're not just trading crypto. How is mining crypto different than somebody who's trading crypto?
The mining of it would be treated as business income. So at that point, you know, whatever income you're earning off of it, that gets reported as your business income. And then you, from that, you would be able to deduct, you know, all of the, you need a ton of computers to do that stuff and equipment and everything. So all of the money you spent on that stuff could be deductible from there. And then whatever other business expenses you incurred in that venture. So yeah, mining it and the gains on buying it and selling it are taxed differently.
So I love the creativity. I picked up on this question. Again, it's in the chat box. Try to get these over in the Q&A box for us. But I think this is a great question. And I'm gonna bet that a lot of the group here does this kind of stuff. There's this whole other way to trade, which is through an IRA, right? A self-directed plan. So Jacob, maybe talk to us about how we get more money into you know, whether it's a SEP, whether it's a solo K. Help us just understand maybe some of the strategies of getting more money somewhere.
Yeah.
But then in addition, talk us through why we might want to be trading out of one of those kinds of an account.
Yeah, absolutely. And so your retirement accounts, this is one of the, in my opinion, the best tax deductions out there. When you look at a qualified retirement plan, you're getting a deduction on putting your own money to work somewhere else. Whereas opposed to, you know, business deductions are great, but you're spending that money, so you're able to deduct it. With qualified retirement plans, you're literally just moving your money somewhere else and allowing it to work for you, but getting a deduction on your taxes. So absolutely brilliant idea. The couple of examples would be, you know, as a business owner, a lot of times when they first start, you'll start out with like an individual IRA. And this could be one that you start from scratch, or it could be rolled over from your former employee or employer, like if you had a 401k plan. So with an individual IRA, you know, every year you can put up to $6,000 in there, which is, you can grow tax deferred. You can, if it's a self-directed IRA, you can do all kinds of fun investment stuff with it, but it's a tax deduction too. So if you're in a 20% tax bracket, you're automatically, you know, saving off of $6,000, 20%. You're getting a free $1,200 basically. And so, you know, that's really the entry level setup. You get into some more advanced stuff like, you know, solo 401k plans and SEP IRAs, like as your business grows and so does the income, you know, those plans are great. You can put up to 58,000 in there, which is a deduction from the business and your personal income. And that's, you know, over 50K that you're putting into these accounts where you can invest, however you invest it is up to you, but there's a lot of different things you can do with it while it's there. So looking into that one, that's, you know, we had the questions earlier of like, if I just started my business, what do I do? You know, we kind of went down that road with the qualified retirement plans. That's like, once your business is really making money, like once you realize this is something that I'm looking at doing and it's going to be long-term, qualified retirement plan should absolutely be your next conversation.
Awesome.
And one thing I'd point out there, we talk about these SEP plans and these solo Ks. We get real excited about those, right, Jake? You know, you and I have had this conversation. I remember being so frustrated as a business owner early on when I realized I could have been using a plan and putting over
for 10 years or however long. Yeah.
And my accountant had never told me about it. This is before I was in the tax game. And I was so upset that my accountant had never shared with me this idea, right? But one of the things too is depending on how you're structured, if you're married, it could be those limits for each of you. So again, if you're a real high income earner and your business is doing really well and you and your spouse happen to be on it, that could be upwards of close to $120,000 that you're able to put in between the two of you. It's a great way to sock away real substantial dollars. Now, Jake, I'm going to ask you a little bit of a more advanced strategy here. Let's say I get money into one of these SEPs or IRAs and I've got it in there tax deferred, and maybe I'm younger. Can I then roll that money over to a Roth, pay taxes on it, and then let it grow tax free? So maybe I take a hit up front, but then I get this money in a tax free account. Talk us through a strategy looking like that.
Yeah, absolutely. And so your IRA is this pre-tax money that you're putting over there. And so, you know, if we were in a live room full of people, we could probably start a riot talking about if taxes are going to go up or go down or whatever. So we won't get into that. But a lot of people think, or statistically, it really is, tax rates are lower right now than they've historically ever been. So, you know, a lot of people think taxes are going up in the immediate future. So if that was your belief and you wanted to try to counteract that, you can actually do what's called a conversion or rollover from a regular IRA to a Roth IRA, which the IRA is pre-tax. So you haven't paid taxes on that money yet. You can elect to do the conversion of the rollover. You essentially pay the tax on it now and convert it to a post-tax vehicle, where then essentially the money can grow in perpetuity. When you do withdraw it, you would have already paid the tax on it. So.
And we see people do that, especially younger people, right? And I say younger, I'm going to call Jake and I younger. I know we're not the youngest guys in the room, but I don't know, that's a great strategy if you're approaching retirement. But when you still have a number of years in front of you, again, it's kind of a mathematic, you know, exercise. You just look at the math, and we see a lot of people. It's a great way to get a lot of dollars into an account that's growing tax-free.
Not to get ahead of us, or I don't know if you're going to get there, Chris, but kind of more of an advanced strategy too when you're a business owner. You know, a lot of people don't know your children can actually be on your payroll. They can work for you. You can pay them up to $12,000 per year, which is a deduction from your business, is tax-free to them. See a lot of our clients take, you know, that $6,000, put it in a Roth IRA for their children. You know, these things can grow over 10 years and literally like fully fund their college tuition, or they want to start a business or buy a rental or whatever. So just the more you learn about this stuff, it's kind of a constant windy road, which is why I enjoy it. But yeah, those are the kind of things we love digging into with our clients and giving them a real detailed plan on how to move forward.
And one thing I'd say about that, Jake, you know, you usually I'm the creative guy and then you reel me in, but I'm gonna play the opposite role today for just a minute. I think there are a couple of cautions. We hear this idea of putting kids on payroll, and it's a great idea. I think I would just say, hey, let's be cautious in the way that we do it. Not that we shouldn't do it. Let's just make sure that we're actually providing a real service. Again, I come back to this word defensible. Nobody wants to get in trouble in an audit. And so, you know, people often ask, well, hey, is there an age limit? The answer is no, right? I could pay my 2-year-old. The question is, what legitimate value could my 2-year-old bring to my business? And you know, I could probably justify my 12-year-old coming in and cleaning my office and pay her, but I can't put my 2-year-old on payroll to clean my office. But you know, Jake, I know it's an example that you shared a lot. Could my 2-year-old legitimately be a paid model that I use on my website or on my marketing pieces? And the answer is for sure. And you can get rates as to what models are going for to do that. And so I think as you do some of these things, taxes are fun. There's a lot of things that you can do. I think the caution that we would just give as a whole is let's be creative, but there's enough room inside of the rules. Let's make sure that we work inside of the rules, and that the positions we take are actually defensible, so that in the unfortunate event that we get stuck in an audit, it doesn't suck the life out of us because we've done things we shouldn't do.
And we just on that note too, if I could chime in for a sec, but don't let me do this on every one because we'll never finish here. I got a story for every one of these, but we've seen in audits before where it was the child modeling fees, and it was $3,500. And at the end of it, the auditor said, you know what, I would go for it if that was a one-time payment for $3,500, but it wasn't. You paid them, you know, however much per week throughout the whole thing. So it just doesn't make sense to me. And so think about it like that. You know, like Chris said, if they're going to come in and clean the office, they need to be paid when they do it. It needs to make sense and it needs to be defensible. So that's just a fun example of that one.
I'm going to come back to one more crypto question, if that's okay, because I actually think this is an important one, Jake.
Yeah, sure.
And then I see a couple about real estate that I'd love to pick your brain on. But, you know, what if I've taken a loss in crypto, right? So let's say, you know, we hear all the stories of people turning their crypto into millions, right? But unfortunately, there are people that have lost money. Can I do anything about that? Is there anything I can do when I'm losing money be it crypto or stocks or whatever it is, what can or should I be doing?
Absolutely. You can deduct it as a loss. Goes back to like why documentation is so important though. Larger losses like that one, I'd never tell anybody you're going to get audited, but I wouldn't be surprised if something like that in a few years gets questioned by the IRS. So having your documentation in order is key. You know, when you invested the money in there, the trades you made to lose it. So just getting as much documentation around it as possible. But yeah, it could absolutely be claimed as a loss. The not so fun part about that is the capital gains loss limitations cap out at $3,000 per year. So it would basically be assigned to the tax return in the year that the loss was taken, and then it would whittle its way down 3,000 at a time over however long it would take to do that. So.
Great. Sean, are we off track at all? Is there anything you want to get us back on track with?
No, that's great.
And course correct us.
I think in that instance, I think he said he lost 40,000. So what you're saying is he'll do 3,000 every year as well. That's interesting.
That's the not so fun part. So
yeah.
But I think
unless they had other passive income that could be offset by. But if there's no other passive income, it generally caps out at that 3,000 per year. So.
And I think a point along that line though is, again, it's important to get that loss on the books so that you can take advantage of it, right? Because if you don't get it on the books, it becomes problematic. You got to make sure you get that on the books and you record it.
And having as much documentation as possible on that is absolutely a requirement.
So can we shift gears, Jake and Shauna, for a minute to some real estate questions? I love this. We built a new construction second home that we're going to use as a short-term rental. So it's going to be completed next year. You know, help us understand what types of things are or maybe aren't deductible, right? This is a short-term rental. So, you know, furniture, marketing, I mean, help us understand what might be deductible here with the short-term rental.
I love this one. The short answer is everything. But it goes by it's called the placed in service date. So keep record, you know, sometimes it takes over a year to build these homes, but keep all the records of all of the contracts with the builders, the landscaping, if you had the original purchase of the land, basically everything leading up to it. And then the year that you place it in service, which is basically the first time you rent it, or at least put it on the market to rent, that's when it would be considered a short-term rental. And then we could start to depreciate the total value of the property over a certain amount of time. With new construction, it's a little different, but there may be, if you bought the appliances separately and all those sorts of things, we might be able to depreciate those in a shorter amount of time. But essentially, everything you put into it will become tax deductible. It's having good records is always key there. And then it would actually take effect in the tax year that you place it in service.
So talk us through depreciation. You bring that up, right? This opens up this whole world to depreciation, which is a real fun world. There's maybe some things to be aware of. Give us some direction on depreciation.
Yeah, so the short definition of depreciation is the IRS allows you to deduct the total value of an asset and over a period of time instead of just in that first year. So in regards to rental properties, you take the value of the property itself, not including the land. So just kind of making up, you know, for an example here, these people, they bought the land for 50,000, you know, they built a house for 200,000 on there. The 200,000 would then goes on what's called a depreciation schedule, and that $200,000 gets deducted over 27 and a half years. So coming up with a dollar amount each year that you automatically get to deduct against the income that it's bringing in.
So now I'm gonna go down this kind of vein here for just a second, Jake. I'm gonna get to a real creative strategy here in just a second, but to kind of in between, let's just talk about 1031 exchanges for a minute here, right? We've acquired a property and we now are going to get rid of this property for whatever reason, right? Talk us through what we need to be doing, and maybe talk us through, I think most of us have heard of a 1031 exchange, but maybe just quickly what a 1031 exchange does and just some of the things we need to be aware of when we do it.
Yeah, it's essentially deferring the gains on the sale of an asset upon disposal of it. So with a rental property, essentially, if you built this rental, you turned it into a short-term rental, had it for a period of time, you could sell the property. Then all of the gains you make on there could actually roll over into what's called a 1031 exchange. You could roll it over into a new property. Has to be a like kind. It's a 1031 exchange, also known as a like kind exchange, where and then you essentially wouldn't pay taxes on any of those gains that you had on the asset. So
I love that. I can think of that in cars, like when you trade in a car and then you don't really pay tax on the.
there you go.
I have to do. That's how I have to.
But it's like trading in your house for a bigger
Yeah.
one. So.
Yeah. Okay.
So let's run through. Let's run through a little. Let's get a little more creative here, though, Jake. Because I think sometimes people don't realize that perhaps there's ways to trade in one car for two cars.
Yeah.
Right,
the double 1031, the elusive double.
Parlay Shauna's example here, right? Is there a way, or what can I do to parlay one car into two cars or three cars?
Yeah, you can do the elusive double 1031 exchange, which you can essentially take the gain from one property, invest it into two properties, and you're deferring the tax too. So we've seen clients do that and multiply the amount of properties they have very, very quickly. So
it's a great strategy. Now another little creative strategy here on the real estate side, and this may or may not be right for everybody, but is there a way to move taxation from a rental into a personal property and take some of the benefits there? Maybe explain to us why that would be a benefit potentially, and is there a way to do it?
Yeah, absolutely. And that's a different section of the IRS code. If I was really good, I could come up with it off the top of my head. But essentially, there's another rule that applies to primary residences, where if you live in that property for 2 out of the past 5 years, you can defer all of the gain on there too. So what we've seen clients do is essentially start out with a rental property, can rent it out for however long, really could be rented out for 10 years. But then if the owner were to move into that property and occupy it as their primary residence for a minimum of 2 years, they could sell it and defer up to $250,000 if they're filing single, or up to $500,000 if they're filing married. They could essentially eliminate paying the taxes on that portion of the gain. So great strategy right there.
So this always leads to the next question. If I got into it with a 1031, can I double dip, right? So if I use 1031 exchange money to buy a rental, and then I say, hey, I'm trying to get rid of it, I want to get my cash out, can I then double dip on both sides of that coin?
This is a great question. This I was doing some more research on this the other day, actually. So this falls in the kind of the same category as reasonable salary under the S corporation, where there's not an actual definition there. If we were gonna give people, the closest advice would be you need to have it as a rental for at least 12 months to be able to justify, hey, it was a 1031 exchange, we kept it for a rental for a period of time, and then we turned it into a primary residence. So yeah, you can start to mix and match those strategies. I mean, you think you could be deferring and then, avoiding hundreds of thousands of dollars in taxes potentially. So awesome strategies.
So here's an easy one for you, Jake. What would you recommend an entrepreneur use? What system, what software to track expenses, receipts, etc.? Just any advice? Okay, we want to get organized. How do we do it?
QuickBooks Online is my answer. There's a ton of them out there. There's Xero, Hurler, a bunch of different ones. QuickBooks Online is the most popular and user-friendly enough that's what we recommend to all our clients. So.
And I would say, just along this line of tracking, one of the questions here is, I started a side hustle a year ago and I haven't made money yet. Should I still be tracking all my expenses? The short answer is absolutely.
Absolutely, right? Yeah. And there's a lot of reasons, but one of the main ones is, people say that, like, well, I haven't made any money. I'm like you've made $0? Like, well, no, but I haven't made any money. Like, you made $0. Like, well, no, I made $60 for whatever. And that changes the whole kind of ball game right there too. So yeah, absolutely. Anytime you start a side venture, whatever it is, if it's, selling roofs on the weekend with your buddy or anything that you're doing as a side business, absolutely track any of the expenses that go into it and then have a good conversation with a professional. A lot of times you'll be surprised how that stuff could benefit you. So
I have a question on that topic. So say you're starting a side business and you don't know if it's going to take off yet. So you kind of probably are buying a lot of the tools or equipment, say in your personal name. When you do sort of realize like, okay, this is going to work, and you like say start an LLC or whatever, can your LLC like buy the stuff from you personally to get it on the LLC books, or how does that work best?
Absolutely. You could do that if it was bigger, equipment or vehicles or something like that, then absolutely that happens. If it's smaller one-off stuff, a lot of times we would just deduct it on your personal tax return for that year. But the importance of tracking it is just another example of that too. So the answer is yes. Yeah, the level of what we're talking about would determine kind of how fancy we got on the actual transition though. So
nice.
Shauna's great at these, Chris. Can we have her on more? Like she's got good questions.
I have a lot of questions.
Yeah.
We'll bring her on next week on our side of the thing.
Yeah.
We'll let her run with it if that's okay.
Yeah, I'll be there.
I think along this line too, it's important to recognize that even in my business, there are some limitations as to what can be deemed as a loss. But if I have a W-2 job and I take some losses, there are some losses I can deduct from the W-2 side, so to speak. Now there's some limits on that, but just because I'm losing money doesn't mean that it doesn't potentially benefit me. But the other thing is, depending on the rules, I may be able to take some of those losses and carry them forward to year 2, year 3, year 4. So even if the rules don't allow me to take the totality of the loss this year, again, the tracking and the recognizing those losses matters, because hopefully we're planning on making money year 2 or year 3 or year 4. And now all of a sudden the money starts coming in. I can go back and take some of those losses. I mean, you want to know how Donald Trump paid no money in taxes, right? It was because he had losses from previous years, and he knew what he was doing, and he was able to hold on to those and use them when he saw fit to use them. And so people can hammer Donald Trump, but it's the rule, right? It's the law.
We get that one a lot, Chris. I'm glad you brought that up. And yeah, you lost hundreds of millions of dollars on, I don't remember which project or whatnot, but that was a big part of the whole, when tax returns came out and everything. Like, well, and lost several $100 million a few years before. So that had a big part in that whole discussion. So,
yeah. I know we're running short on time. There's a few more questions we'd love to just maybe burn through, Jake. So maybe we can't talk as much as we'd love to. But man, we got a few here. So can I, as a sole proprietor, can I pay my kids? So we brought up this idea of paying our kids. How do I need to pay my kids to make this legitimate?
Yeah, you essentially run them through the payroll as a typical employee. The big part there is they have to perform a role in the business. So you essentially put them on payroll like a typical employee.
And that's going to lead to the next question. Do I have to have them on payroll? Can I pay them as a 1099 contractor? How do I need to do that if I'm paying my kids?
You definitely want to run it through the payroll. You don't want to pay them as a contractor.
So here's a great one. And Allison poses this as an if question, but I hope this is actually what's happened to her. The question is, if you come into a huge amount of money, any ideas as to how I can not get absolutely crushed when it comes to taxes on that money? Just ideas when I come into a windfall of money, Jake.
Yeah, it really all depends on like where the money comes from. If it comes from inheritance, a lot of times it's not taxable in the first place. I guess it depends on where it comes. So, if it's passive income, then we're going to look for some passive income investment strategies that offer probably something like an apartment complex that offers a large amount of cost segregation in the first year. If it's, you just made $1 million at work or whatever, I would probably encourage you to start several businesses. That would be expense heavy in the first few years. That could potentially turn into something to provide income later. So I think it would really, that's a great question, but kind of a more specific one. So the answer is we could come up with something for you. We just need to know kind of the details there. So.
And you offer free consultations, right? Like, so to get started with you guys.
Yeah, so that's a great question, Sean, and we'll share this at the end too. We actually had a lot of questions about us. I've tried to stay away from those and just provide content, but I'll hit a few of these questions about us at the end. But the short answer to that question is absolutely. You can go to taxhive.com, and because of our relationship and everything, taxhive.com/money school, and you can schedule a free consult with a member of our team to better understand how we work, how we service, and what we do, and how we may or may not fit into your long-term tax plan. And we would love to have that free consultation with everybody on here. Certainly, candidly, we do this because, we love everything, Shauna, you guys do, but we would love the opportunity to earn your business. We believe that what we do is a great service, is a tremendous service, and we're in this niche that services this kind of a clientele, and we'd love the chance to earn your business. We're not saying that there aren't other great accountants out there. There are. But philosophically, if our approach of how we want to work with business owners matches with you, we'd love to work with you. And certainly taxhive.com/money school, you'll just get a calendar from our team and you'll be able to schedule a time. So thanks for bringing that up, Shauna. Jake, I want to ask a quick follow-up on that question. You mentioned depreciation. We mentioned cost segregation a couple times. High level, and I don't want to get too bogged down with this. When we purchase a property, we can depreciate it over years, and oftentimes that's 20, 30 plus years, depending on the kind of property. The reason cost segregation matters, if there's anybody that doesn't understand it, is the code allows us to take certain pieces of a property, especially as we look at the commercial side. This is where this gets real exciting. We're able to take pieces of that and accelerate the depreciation. So you talk about a windfall of money, right? If I put money into a property that has a lot of cost segregation stuff that I can depreciate quicker, I don't have to push that loss over a ton of years. It shortens that window, and I can take a heavy loss up front to offset some of that income that I brought in. Jake, I plan to lend money to my business LLC, and then out of my business, lend that money into various opportunities. What do I need to do to make sure this is done right? So I'm taking personal funds to fund my business. Then my business is taking those funds and funding other ventures. I'm assuming charging interest or taking points or maybe taking equity. I don't know what it's doing, but what do I need to be aware of here?
Yeah, so you want documentation is key here. The initial personal funds you put in are booked as a loan. I would recommend having some documentation there just to outline the parameters of it. Is the business paying you interest back? What are the terms? But one way or another, it needs to be booked as a loan going into it. And then same thing on the way out too. So those loans to other businesses or investors or whatever need to have documentation there and just have clear parameters of what are the payback terms, what are the interest going to be earned on there. And then that interest gets reported as interest income from the business. So.
Right. Again, documentation, right?
Boring answer, but it's a popular one.
I'm sick of hearing us say that, but it matters. Well, if it's all right, I might like to just in one swath hit a bunch of these questions we've got about us at TaxHive, if that's okay. Where do we work with clients? All 50 states. We have clients in every single state. We even have a number of international business owners, investors that are doing business in the US. So we certainly work with people and service business owners everywhere. We do personal taxes, but really our niche openly is to the investor and to the entrepreneur. That's the niche that we really fill. There's not a ton that can be done when you're just that W-2 wager, and that's why Jake talks about start a business, right? But the minute that code opens up, that's really where we specialize. One of the reasons that we feel we specialize there, this question of what's unique about us. Jake and I are doing trainings for our clients twice a month, and we're doing them on specific strategies that accountants, for whatever reason, don't bring up, right? We're talking about qualified retirement plans. We're talking about Rule 280A, the Augusta rule. We're talking about vehicle deductions. We're talking about depreciation. We're proactively putting information in front of you as an investor and a business owner to spark your mind, to get you thinking, hey, what can I be doing? And then what we're hoping we do is we spark something that either you change something in how you do your business to take advantage of the deduction, or you reach out to us, you hit us up on an email, say, hey, Jake brought up this strategy. What do I need to be doing? And then you have that type of access into our team throughout the year. There's no doubt that we earn our money at tax team. Our team does great tax work, but it's really about this additional information throughout the year that puts you in a position to make adjustments in your business and in your investing to better take advantage of the tax code the way that it's written. We do books, but I will tell you, we're not a bookkeeping firm. So meaning if somebody is a tax client and they want us to do their books, that's certainly something we'll help with. It makes our life easier on the tax side if you have a bookkeeper. Jake loves it when we do books because it makes taxes so much easier. But the lift that comes from bookkeeping, honestly, we're not really interested in taking on thousands of bookkeeping clients to just do books. It's a service that we render and that we offer to clients that we're doing the tax work and the tax planning for. But it's not really an a la carte service that we just offer to clients. So I think that might sum it up. Again, how do you get in touch with us? Like we just mentioned, go to taxhive.com/money school and just schedule a free consult. Our team will talk to you about where you're at, what you're doing, and kind of explain to you the little different philosophical approach we have to how we want to work with our clients. And why we believe that matters. And we'll talk you through and help you understand what it is that we're doing and how we're doing it differently, how Kevin's DNA runs through our business. And certainly we'd love the chance to earn your business. And if you've already got somebody who's doing a fantastic job and taking advantage and planning and all these types of things, then keep with them and stick with it. But if for any reason you feel like you're falling short, if there's any question in the back of your mind that maybe you aren't maximizing your deductions, go schedule a phone call with our team, taxhive.com/money school, and let's see what we can do to help you out. But, we're just super grateful, Shauna, that you guys let us come on. And I really hope that this was valuable to everybody who took the time to be here today.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.